Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to a fresh new edition of Taking Stock. We will rewind the clock back 5 days, take stock of what happened during the last 5 trading sessions. But we also, as always, tell you what is important to keep a focus on the coming week. That's what happens every week on Friday here on Taking Stock. I'm Prashant Nair. With me is my colleague Surabhi Upadhyay. Hi, Surabhi.
Hi, Prashant. Well, what a week it's been, right? We've been going through these levels where the index is telling you it's all-time highs, but it's been anything but pretty in the broader markets. And in fact, I'll just quickly run through some of those highlights for the week gone by. Disappointing is perhaps one way of summing it up because, yes, record levels for the Sensex, fresh new highs for that index. The Nifty just 1.5% away from the 52-week high levels as well. But the mid-caps is another story altogether because that's where we've seen a lot of the pain. So we are going to be discussing a lot of these trends. Joining us on the show to do that, we have our experts joining in. MD and Head of India Research at UBS Securities, Gautam Chhaochharia, takes us through all the fundamental cues and triggers that line up ahead for this market. And of course, in a bit from now, we will also get you technical advice from Ashwani Gujral. But just to come back to some of those numbers, and let's just get the graphics up on the screen as well. It has been painful for the mid-cap market. The earlier part of the week might have told us that maybe there was some hope building that maybe the worst of the mid-cap selling is over. Towards the end, we were told that's not the case because Friday has seen some savage selling on quite a few mid-caps, down between 7, 8, 9, 10%. Yes, news triggers have been there, but beyond news as well, just the extent of the fall has been quite dramatic, whether it was some of these multiplex stocks or whether a couple of the banks where earnings came out, or the IT companies where earnings came out. So, Prashant, I guess, the talk in the market is just this, right? That you have the sort of passing the parcel happening between the HDFCs and the Reliances of the world. But beyond these 5, 6 names, it's a different market, I guess.
Oh, absolutely, Surabhi. I think, let's take stock of where the big indicators really stand, right? Let's start with equity indices. The pain point for equity markets, be it US, Europe, Asia, was really here in Asia. Hang Seng, the Nikkei, the Chinese markets, they were all under tremendous pressure. What we've seen the week that has gone by is that there has been some stabilization which has happened. And actually, in some cases like the Hang Seng and the Nikkei, markets have come back above crucial levels. That's point number one. The market here, of course, the Sensex has made a new high. Nifty is about 2% away. Of course, the point about mid-caps and small caps is 100% taken. India also remains one of the very few markets with any sort of meaningful gains. The other market is the US. I'm talking about big major markets. YTD, there aren't very many markets which match up to what India has done so far, and the gains here are not spectacular to begin with. The dollar index, that is starting to show that it maybe is topping out. That's not bad news for emerging markets, especially markets like India. Oil is looking softer, 100%. It's down about 5%, lost 5% in the week which has gone by. You look at the rupee, the dollar rupee, it basically made a new high for the 4th time in the last 5 years or so. What has happened, though, is that it topped out each of those 4 or 5 times. Will it happen again? There are some who are betting that with the dollar starting to look a little weak, the dollar index itself starting to weak, it will show up in individual currencies, and the rupee is no exception. So that is the rupee. What is the 10-year doing? The 10-year has failed to take out the 7.8 odd mark. Actually, it's broken below an important level, and there are indications that actually it may head south, head lower. You put all of these together, lower dollar, lower oil, the rupee which is actually stabilizing, equity indices around the world which are looking better relatively. It's always incremental, not absolute. And you maybe start to wonder whether this broader correction that we've seen in broader market in the mid caps and small caps will drag the Nifty lower, or it's going to be the opposite. We'll find out. Come to trade. The graphic on your screen has got 3 dates. What it basically tells you is that from the time that Trump first announced those $50 billion worth of tariffs on Chinese imports to the time that it actually went into effect, it was 3 months. The latest announcement is $200 billion worth of goods which will attract tariffs by the US. Will we take 3 months? We don't know. The point I'm simply making is, this trade war thing and the chatter isn't going anywhere. The consolation, though, is between each episode, hopefully, we will have enough and more time. Surabhi.
Absolutely. Well, let's discuss some of these cues and triggers for this market going forward. Gautam Chhaochharia of UBS is with us. Gautam, great to have you on the show. So, you know, how have you analyzed the situation, the sort of market that we are in? Because mid-caps are showing absolutely no signs of respite, and then you have a couple of these stocks where all the money, all the buying is concentrated. So the index is at all-time highs.
So in a very simple way, the way Prashant was describing, the macro factors which have played out till now and some respite being seen recently is what is a perfect way to describe the market movement. So markets corrected earlier, mid caps did very badly, and then over the last few days we have seen the markets picking up, but not the broad markets. It's a very narrow few stocks picking up, which shows investors are deploying surplus cash, but deploying the surplus cash to possibly hide in those big names, few quality big names, rather than willing to take a big risk from an absolute return perspective.
And why do you think it is happening, Gautam? You know, the earlier episode of mid-cap and small-cap correction, there were a lot of things to blame, ASM, and et cetera, technical reasons. What is happening now?
So I think technical reason was just one of the reasons, frankly, and that was the initial phase was being given more as a post-facto rationalization, I would say. But the factors for mid-caps are multiple beyond the technical restructuring schemes, etc. To begin with, valuations, they were in frothy zone. If you look at historical relative valuations, etc., they were off the charts. And that was making many investors nervous about putting in more money. Then obviously the broader macro narrative started hurting, and then the first impact obviously is always in the more riskier part of the portfolio, and from a liquidity perspective, that's where mid-caps come in. So they obviously got a lot more hurt. And finally, end of the day, earnings. So while we have kept on hoping for earnings momentum for the broader markets, even if you look at these mid-caps, we still haven't seen in a broad-based way positive earnings momentum. There are always individual stocks, but in a broad-based way, we have seen, in fact, much sharper earnings cuts for mid-caps versus, say, large caps or Nifty over the last few years and this year also. So clearly, there was vulnerability building up, and that's what led to the correction. And then it becomes kind of, I would use the word circular. They correct, people get more nervous, and you really start focusing a lot more on fundamentals than you sell. And frankly, to add to all that narrative, if you look at our investor discussions over last month, 2 months, compared to earlier, where the typical discussion was buy on dips, at what level you buy, we have started seeing discussion points among investors, whether it's a sell on rise market versus a purely buy on dip market earlier. So that all of this discussion points also adds to the narrative and sentiment around the market, which is not good for mid caps. And despite the correction, top down, bottom up, from our perspective, we still don't find the risk reward attractive for mid caps, even at these levels.
Just to extrapolate the point on earnings, Gautam, I was going through your note earlier, and it seems that, I mean, you do think that there are further downside risks to some of the estimates that we have floating around, even for the current year. Is that so? Because of the talk of the last couple of weeks was that micros might be a little confusing right now, but macros might be confusing, but micros are looking good. But is there a risk to the micros also?
So that's the point. So there are two parts of the micro. One is the optical reported number. That's definitely looking better, including for earnings. So if you look at Q1 fiscal year 19 forecast for Nifty, it's somewhere around 21-22% for the street. Can they deliver that? Possibly. It's not out of range of being realistic. But if you look at the compounded growth rate from fiscal year 17 over a 2-year period, so stripping out the base effect of demonetizing GST, the compounded growth rate is 7%. And that's exactly the point, that what we are seeing in terms of optical growth recovery is off the base of demonetization and GST. We are recovering back to growth rates for both earnings and macro to where we were pre-demonetization. Whether it means that this is the beginning of the cycle and we start growing at 8% plus, I don't really see that in any GDP forecast. While the earnings forecasts kind of seem to indicate that we will be at 8% plus growth rates over the next 2-3 years. That's where the disconnect is. My guess is we are extrapolating the optical base effect driven growth to beyond the first couple of quarters. So the street forecast of more than 20% earnings growth for fiscal 19 and fiscal 20 for Nifty is definitely going to see cuts.
No, when you say we're just getting back to pre-demonetization levels, you're talking about A, Nifty, and B, are you talking about absolute earnings number?
No, I'm talking about growth rates. So earnings growth rates pre-demonetization level, GDP growth rate pre-demonetization level. So the economic activity and earnings activity will go back to pre-demonetization level in terms of growth rates. But the growth rates being reported now will seem optically higher because of the low base. But the underlying trend is similar to pre-demonetization levels, which is good, it's not bad, but not what I think the markets are extrapolating beyond the couple of quarters.
Okay. Finally, what about the other bigger risks? I mean, has this just been an illusion rally, Gautam? That's the question, because when oil prices are elevated, FII selling is still continuing. It's ebbed a little bit in July, but still the numbers are down. So is this then an optical illusion of an index rally? What do you see? I mean, you have three different scenarios: base case, bear case, bull case. Which is a likely one that you think might play out?
So our base case is still for Nifty to go down to 10,500 by end of this year. So there is absolute downside from current levels. And looking at our scenarios, risk reward is clearly unattractive. But the rally clearly is very, very narrow. And that's why the index suggests a different picture versus the broader markets, which doesn't give us confidence that the underlying broad momentum is positive for markets to continue to do well. And these individual stocks doing well, as we discussed earlier, seems to be more investors rotating or deploying the surplus cash with the view of protecting capital in quality names.
Okay. So you see on an absolute basis risk reward being negative. You think Nifty should be down at 10,500 by the end of the year. Any pockets where you see reasons for absolute gains in the market?
So absolute gains is becoming more difficult if you look at the Nifty levels. And I'm not all talking from a one-year perspective. The long term, obviously, India's growth story will ensure positive compounding returns for many of the sectors. But from a one-year perspective, the absolute returns will be in select pockets. And it's going to be a lot more stock than sector-driven. Because within the sectors also we are seeing a lot of divergence in terms of performance and expectations being mismatched. But generally speaking, we see select opportunities in automobiles, in financials, including corporate lenders, even in non-bank financials, we select opportunities. But at overall portfolio level, we do see IT being an overweight call, given the view on the market also. And we still remain constructive and overweight on property.
Okay. What is the view on pharma specifically, Gautam? Because that's the one area where, I mean, people have tried to hunt for value, pick a bottom, and at least, you know, there was some optimism over the last couple of weeks. Do you think that pharma has made a durable bottom? Is that a pocket of the market where you'd advocate people to go in and buy?
So our view is, so from a portfolio perspective, we are still neutral. There are a couple of stocks which looks interesting, but at a broader level, we still don't think fundamentally the pricing pressure in the US, which was the big driver of these stocks surprising negatively over the last 3 years, is done and dusted. There's more to come possibly ahead. And therefore, whether we have made a more bottom or we'll see no more earnings momentum being negative, we still don't think so. There's still some more to come. Even now, over the last few months, we still haven't seen earnings momentum turn. Until we see that, we can't really call out in terms of the sector having bottomed out.
All right, Gautam, it's a pleasure. Thank you very much for your time. Appreciate you joining in with those thoughts on taking stock. Well, we slip into a very quick break here. But before we do that, let's listen in to some of the top market opinion that we gathered through the course of the week. When we come back, Ashwani Gujral with his thoughts on the market and his trades for the coming week.
I'm of the view that the mid-cap pain could now be behind us, and once the CNX mid-cap 100 gets past the level of 18,700, you could actually see a very strong recovery that takes the index back to 20,000 and eventually to 22,000 and beyond, possibly by the end of this year. So I think that the fall in the mid-cap space has got arrested around the 17,800 level, and if that is a possible bottom, I think this is a great opportunity to be buying into the mid-caps.
Domestic demand is
great opportunity to be buying into the mid caps.
domestic demand is largely in place at this point in time. Last 6 months we have seen a fairly strong improvement across the board, and though the global exports and other trade related issues could be a bit of a concern, but most of the mid caps are probably in very niche areas and would not get really impacted by some of the export related issues. So broadly, I think the fundamentals are good. The valuations are intact now after the correction. So I think I would definitely argue for a bit of shift back into the mid cap, small cap space at this point in time over the next 3 months.
The structural long-term story on a 3 to 5 year story, that stays very good. The main driver behind that is we finally, after many, many years, we're beginning to see corporate earnings growth picking up. Our viewers at Deutsche is we are expecting the Nifty earnings growth to be about 20% for this year. And this should continue into next year as well. Sensex is 37,000, Nifty is about 11,400.
We are not bearish, but and nor do we want markets to fall, frankly. But there has to be very selective bullishness here on. And obviously, when you look at the valuation disparity between mid caps and large caps, it's the large caps that come into focus. I think the mid cap space has already seen a broader carnage of sorts. Good enough stocks are like 20, 30, 40% down from peaks. So it's not that it's going to be the large caps next. In fact, that money will, over a period of time, come back into the large caps.
Company's earnings season is off to a good start, and we should get some good results and some good signs of momentum from companies across different sectors. The mid caps are clearly lagging in a big way, and it is a very narrow rally.
Every investor is a value investor, so you have to chase the value, not the price. Price will keep moving up and down. So when the loss is in the price, not in the value. So when the price moves down from say 100 to 50, the value might have gone up from 50 to 60. So what we are looking at, what is the loss is in the price.
Welcome back. Here with us on Taking Stock, and now joining in to talk technicals is Ashwani Gujral. Ashwani, it's been quite a week for the street. We've seen all-time highs on the index, but stocks, particularly mid-caps, are bleeding. Your reading?
Fairly clear that a narrow market has very limited upside. Now, yesterday and day before you had Reliance or TCS doing 5-6%. Today you didn't have that. So that way, given the way the momentum with which mid-caps are falling, I don't think you'll be able to cross 11,050, 11,070 with any sort of sustainability. So right now this zone is perfect to go short. Why? Because your stops are very close by. If you start taking out day before's high, then your trade is over. But if this continues and every day you have 1250 decliners to 350 advancers, finally the large caps will also start to come under pressure. And the market will sell off, and maybe first target could be 850, 900. So that way, it's not looking strong at all, while large cap indices are not still moving. But it's clear that the market is lacking strength or momentum to move higher.
Okay, so if the Nifty starts to break down, what levels are we looking at, Ashwani?
See, the breakout zone of 10,850, 900, and it shouldn't be surprising because, that sort of breakout needs clarity on election, which is the macro event. You've seen crude prices fall, inflation was better than expected. All that has not led to, financials moving higher, which means that those are not enough triggers at these levels to move up, and in fact have been used by the market to engineer a sell-off.
Okay, Ashwani, now let's talk sectors. What are the weakest links in the market right now?
See, PSU banks are the weakest. Along with that, basically the entire mid-cap area is extremely weak. NBFCs are looking fairly weak because people were long NBFCs and expectation of them moving higher. So this entire, domestic area, which is there, financials, NBFCs, all sorts of infrastructure. If you see the way, NCC, NBCC, all these stocks are crashing. Basically, it does not seem like there are a lot of buyers in any of those mid-cap type stocks. And that's where the shorts are going to make a killing next week, because if large caps also start to fall, then mid-caps will really get bludgeoned.
Ashwani, just one last point on the market itself. Some of the indicators, be it oil, be it other global equity markets or yields, you put all those things together, they're not looking exactly bearish. Actually, incrementally, there is a bit of improvement in all those things. How does that really fit in with your view that maybe the mid caps and small caps are going to prevail over large caps? The Nifty is going to head lower.
See, these are the right answers at the wrong time. Had the Nifty been 10,500, all of these factors would have led to a large rally. But we got the rally before these factors, and at 11,050, 70, I think people want to get off the bus, before the opinion polls and our music starts. So the kind of sell-off we've seen last couple of days is very strong profit booking, and people who've been holding through this turmoil, etc. Once you see the previous high back, they just want to dump it.
Okay, all right. In that case, what should be the trades for next week, Ashwani?
See, for Monday, particularly PSU banks have closed week. So Canara Bank is a sell with a stop of 236, target of 224. Engineers India is a sell with a stop of 125, target of 117. And Nagarjuna Construction is a sell with a stop of 92, target of 84.
All right, Ashwani, thank you very much for that. You have a good weekend, and we will see you again on Monday as well. Prashant, let's see what the next week brings. This one has been sort of a tale of two cities, I guess.
Thank God it's the weekend. Thanks very much for watching. We'll see you bright and early Monday morning.